This chart tracks OpenAI's projected cash flow. By 2029, the company will burn through $115 billion in capital. But against that deficit, for its late 2026 public offering, OpenAI is aiming for a valuation of $1 trillion. This creates a massive financial contradiction. How can a business losing tens of billions of dollars justify the largest market debut in corporate history? The losses are driven by the raw cost of compute. Their Sora video generator, for instance, cost an estimated $15 million a day to operate, while generating only $2.1 million in total lifetime revenue. At the same time, competitors are proving more efficient. Anthropic recently reached a $30 billion revenue run rate, with model training costs reported at a quarter of OpenAI's. OpenAI is navigating a financial crisis that forces them to alter their corporate DNA to reach the public markets. In 2015, this started as a boutique nonprofit research lab. Today, it functions as a massive corporate machine. To scale, they eliminated the nonprofit board's control and in early 2026 officially restructured into a public benefit corporation. This legal shift allowed them to absorb a record-breaking $122 billion funding round, which required a structure that could provide unlimited returns to investors. That capital came with new requirements for efficiency. By April 2026, OpenAI abruptly shut down the Sora app, despite its massive social media presence and a $1 billion character deal with Disney. The math of the compute supercycle made the product untenable. The cost of generating synthetic video for consumers simply far exceeded the revenue it could attract. OpenAI is prioritizing unit economics over technical novelty. To clear the path for an IPO, every compute-heavy project must now justify its existence on the balance sheet. Even with millions of ChatGPT Plus subscribers, consumer software fees are not enough to bridge a $100 billion funding gap. Their internal roadmap reveals a different plan, reaching $100 billion in annual advertising revenue by 2030. To build this ad network, coding, browsing, and chat are being merged into a unified super app. As an autonomous agent, it identifies your intent and matches you directly with a provider, instead of directing you to links. Google monetizes the click economy, the traffic between a search and a website. OpenAI is targeting the intent economy, where they control the user's ultimate goal. OpenAI is securing a $1 trillion valuation by packaging and selling the intent of its 3 billion projected users. In the fourth quarter of 2026, this strategy will meet its debut on the public market. CFO Sarah Friar has announced that 30% of the IPO shares will be reserved for retail investors, a massive increase over the standard allocation. This has created friction with the SEC, which is currently drafting new disclosure requirements to force AI companies to better explain their structural and financial risks. Meanwhile, Elon Musk's $134 billion damages claim remains a significant wildcard, challenging the company's right to abandon its original mission. Retail investors participating in this IPO are underwriting a high-stakes transition. They are betting that OpenAI can capture Leave Internet's advertising spend before its $115 billion deficit triggers a liquidity crisis.